Hello, everybody. Welcome to M&A Verse, the number one M&A podcast. Here we have Ansi Monsión and our special guest, Len Bland. Len Bland, if you don't mind, could you please introduce yourself and share with the people a little bit about your background?
My name's Len Bland. I run Concept Equity Group. We prepare entrepreneurs for investment. We provide strategic and financial advisory services. We've helped them raise millions. I started my career as a CPA. It was a great financial foundation, but I didn't love it. Shortly after that, I got my MBA from Northwestern's Kellogg Graduate School of Business. I liked information systems, so I helped companies like Unisys and Kraft Foods automate their business processes. Then I had the opportunity to go to work for a Silicon Valley software vendor and ended up being vice president of sales for a couple software companies. 18 years ago, I started working with an entrepreneur who was raising capital, and I discovered my true passion. I love providing insight that leads to entrepreneurial growth. So since that time, I've been running Concept Equity Group. And while I did that, I found a world-changing invention that I just had to be part of. That became the basis for Nanogas Environmental. We clean and energize water with tiny bubbles.
And we kind of talked about that, you and I, in a previous conversation a week or so ago. Kind of interesting things you're doing there, Len. I want to touch on that later on in the podcast. But now what we want to do is kind of like talk about some of the topics that we have for today, for tonight's show. And then after that, we'll get into more about your background, Len. Valentino, what do we have? What's our topic for tonight?
Absolutely. First, we're going to start with Silicon Valley Bank. It's a big topic. Everybody's been talking about it. There's a lot of things happening right now. I was going through a few articles, and Len, the recent collapse of Silicon Valley Bank and the subsequent panic in the banking industry has made headlines. I'm sure you've seen the news. The central bank's top regulator has admitted that the banking supervisors didn't fully appreciate the extent of the vulnerabilities as the bank grew in size and complexity. What are your thoughts on this, and what could have been done differently to prevent this scenario?
Well, first of all, I think that Silicon Valley Bank was a tragedy that didn't have to happen. Number one, I think the bank was poorly managed. And I've talked with other bankers about this, and they agree. The fact that you have a bank that was that big, that let go or had their risk manager leave over a year before they had a problem and didn't hire a new risk manager, that just hiring a risk manager who would have known what to do and how to manage their assets probably would have stopped the problem. So on one hand, it was a problem of management. On the other hand, it's a problem of governance, I think, from our government. We had Dodd-Frank laws that covered all the banks, but somehow we wanted to support regional banks and let them grow, which I think is great because we all need community banks because those are the bankers that can get to know us. But somehow that limit for community banks, Silicon Valley Bank lobbied and was able to get that increase to the point where, they were one of the top banks in the nation, but they were still termed a community bank, which was ridiculous, and they didn't have to follow the higher requirements that the big banks need to follow for Dodd-Frank.
Right. So you mentioned risk management. There was that lack of risk management. What makes a bank that big oversee those aspects, which are essentially fundamental?
We've got a medium to large bank here in Chicago called Wintrust. I met with some of their people responsible for security and responsible for risk management. They took their job very seriously. And I think the big banks do because they have regulations associated with it. I think there's always banks, there always have been banks, and there always will be banks that don't take that seriously and mismanage, and some of them get caught with because of that mismanagement. Some of them take their job very seriously, and a bank can, in this environment has to be careful with the rising interest rates. The interesting thing is that Silicon Valley Bank CEO was on the San Francisco uh, Federal Reserve. And so he had earlier warning than every other bank. He had, an extra year or plus warning that interest rates were going to go up, and they could have easily managed for that. I think there are certainly small banks that might be less sophisticated that could find themselves in a little bit of trouble because of that. But I don't think it's going to be like 2008.
Right. The ripple effect of the SBV collapse led to the failure of New York-based Signature Bank, and it sparked an intervention by financial regulators to protect uninsured depositors. How do you see this impacting investor confidence, and what should be the immediate steps to reassure the market?
I think they're being taken. I mean, although I don't think anything's going to get passed, any new legislation will get passed to handle it. I think we all have to wonder why, with the whole banking debacle in 2008, there was not a single banker went to jail. And, I still have a question about that. But I think the real question is, should our government, which guarantees all deposits under $250,000, should they be guaranteeing deposits over 250,000 like they're doing? Should banks be too big to fail? And I think that's an open question that regulators and legislators have to think through.
Right. So, as we mentioned, risk management, there seems to have been a lack of that at SVB, with a growth at all cost mentality that emphasized short run profits over managing risk. As an angel investor, how important do you see the role of leadership and culture in managing risk and ensuring compliance?
When an investor invests, I think they need to look at that risk and they need to look at the management team. Some investors invest and try to identify every risk that they can identify, and then see if the entrepreneur is aware of those and has a mitigation strategy in place. Just investing in early stage companies, there's going to be risk. The question is, does the company recognize them, and are they taking steps to handle those? So, you have to think of yourself just like a bank does. One of the surprising things for me as an entrepreneur and when I help investors is that many of them try to get to know the entrepreneur running the business, but there's quite a few angel investors that will invest without knowing, without doing all the due diligence. At one point, I was thinking of starting up a venture capital fund. And my number one thing that I wanted to do was make sure that if there was a risk that I could identify at the time that I was looking at the company, I wanted to make sure I knew about that risk. If there's something that happened afterwards that I couldn't have known about, I was fine with that. Companies fail all the time. But I wanted to make sure I think investors need to think about the company that you're looking at shouldn't fail because of something you should have known. And so from a entrepreneur's perspective, that means you need to be prepared for the best investors who are going to ask to do due diligence and ask for a lot of information.
Absolutely. Now,
Real quick, hold on, real quick, Beth. Sorry about that. So look, I'm looking at Washington Post, right? They released an article earlier this morning saying that federal banking regulators will release recommendations today, Friday, for how rules should change for mid-sized institutions like Silicon Valley Bank and Signature Bank as they aim to prevent another repeat of last month's meltdown. Do you think they're going to achieve anything with that, or is it all talk?
I see it. I think it's difficult I think that the regulatory body can issue new rules.
Mm-hmm.
I think if those rules rise to the level where they need congressional approval, that's going to be a really tough road to hoe.
You don't think it'll pass Congress?
I don't see them passing much. Do you?
No, no, that's not what Congress is for,
Yeah.
unfortunately. Great, great. Let's go, Valentino. What's the next topic for us?
So there's a thing that they're talking about, and is the impact of social media and technology on the speed of bank runs. The report cited that social media allowed depositors to spread concerns instantly, and technology enabled immediate withdrawals of funding. Can you delve into how this might change how financial institutions should prepare for or prevent future crises?
I think, again, if you have your management in place and you're paying attention, you can be prepared. You can be prepared for the run on the bank, and you shouldn't even see that run if you're managed well. I think it's the ones that aren't managed well, and all we're seeing now is the same thing that happened in the 30s before there was regulation. At least we have some regulation, and some of those deposits are guaranteed. It's not the little guys that are going to be harmed, but it is companies. It's companies get investment of over $250,000. It starts becoming important for you to look at your bank's management and understand enough about that management so that you can determine whether your money's in the right place. Or ask your banker, how are you going to protect me if I have over $250,000 in my account with you?
Absolutely. You got any last points regarding SVB, Ansi, before we move on to the next topic?
No. I mean, Len, we discussed SVB again previously, and I think I asked you if you thought it was any, contagion there in it. Do you think what we're seeing with First Citizen and these other banks right now, do you think it's going to linger on? Like, what are your thoughts on that?
I think it's not going to be as serious as as in the 80s with things like the trusts and savings and loans that needed major rescue, and I don't think it's going to be as serious as the 2008 challenges. I think there'll be some challenges, and there always are bank failures. That's something that we're not going to avoid entirely. There's always bank failures.
Right. But how does this really affect capital raising the way that they were making it? Right. Are we really going to see that much of a difference between, what investors are willing to put out and the amount of founders that are asking for capital? Are we going to see a significant change in that because of the banking crisis?
I think we were seeing a significant pullback in venture and in money available before Silicon Valley Bank failed. We were seeing that pullback because people have been predicting recession for, it seems like 9 months to a year, even though we haven't really had it yet. We still have got rising employment. We're slowing down, but we're going to slow down. It becomes kind of a self-fulfilling prophecy. Everybody pulls back because they think it's going to happen, and then it happens, and they go, "See, I was right." And they go, "Well, that's because you pulled back."
Right.
But so there was a huge speed and effort to get money into the market by VCs and other investors. I think 2-3 years ago. We're seeing a slowdown now, but there's still money out there ready to go in. It's not like huge amounts of assets that disappeared. The stock market has dropped, but it hasn't dropped all that much on a percentage basis. So people still have money. I think what we're going to return to is you should never plan to get money based on the back of a napkin. You should think about, at least go out, at least do a lean startup approach where you've talked to 100 people.
No, that makes sense. Great. Valentino, let's get into our next segment.
Absolutely. So it seems like there's a uptrend in startups buying startups. So, Len, according to recent Crunchbase data, we're seeing an interesting pattern where startups are increasingly being acquired by other startups. So far in 2023, at least 99 U.S. startups have found their new homes in the hands of other startup companies. What do you make of this trend, and what factors are driving this shift?
If you can't get the money to run your startup and you want to keep it going and you have some assets that are valuable, then you look for somebody else to acquire you. And if you're a well-funded startup and you have assets, you say, this is a good time to buy. I could strengthen my company. I could broaden the intellectual property. I could maybe expand the number of customers I can reach out to by buying another startup. I think this is, there's, if you're well funded, then it's worthwhile thinking about, should it be a startup, or maybe there's another company I could buy to get market penetration just to do that in an existing company. So I think it makes sense. And I think when you see cash being harder to get, then you see companies that are searching around for a solution, and you see companies ready to buy them if they've got good assets, if they've got good intellectual property, good people, good plans.
Absolutely. Whit Bauk, a partner at Insight Partners, suggests that the current funding environment is changing, and it's making it more challenging to secure venture investments compared to 2021 and early 2022. As a result, she believes that M&A activity might see an uptick. What's your perspective on this? Do you agree that a tougher investment climate could drive more M&A activity?
I think so. Clearly it can, and it is starting to do that. On the other hand, I just read recently that Berkshire Hathaway has $88 billion in cash. And they just said, and Charlie Munger, who runs it along with Warren Buffett, said he can't find anything he wants to put his money into right now.
Oh, wow.
And to me, that means that we could see, a longer downtrend before people that are well funded decide they want to start buying things cheap.
Great points. Currently, it's challenging to get a clear view of the kind of deals acquirers are negotiating, as the majority of startups that make acquisitions do not disclose what they paid. How does this lack of transparency affect the startup ecosystem, especially for smaller seed stage startups and talent acquisitions?
I think that I'll go back to an example. So I was a co-founder in PatraCorp. They do back office processing for insurance agencies and brokerages. I sold off for 600 times my investment, and the company just sold off part of its company for 149 million. The CEO, who's a friend of mine, had started a company before that during the dot-com bubble, and he thought it was a success when the market fell apart. He thought it was a success that he could get a mid-sized company to buy his company and keep all the employees employed and keep that momentum that they had in providing value going. It wasn't a success for his investors, but that was the best he can do at the time. And, I don't think we're entering times that are as challenging as that. But when you have so many more startups now, I think you have so many more people developing, I'm calling them assets, but intellectual property, ideas, whatever it might be, that other organizations may be interested in. And again, if you can't get your funding and people need to eat, what do you do?
Absolutely. I think that example you provided illustrates a very selfless individual who's looking for the future of his company. It all comes down to making the best of the current environment you're in. And circling back to that, let's talk about valuations. It seems like valuations for public and private tech companies have seen a sharp fall recently. This likely means that typical deal prices for acquisitions are down considerably compared to early last year. Given this, how do you see the M&A landscape changing, especially for startups? And what's your take on the idea that an acquisition isn't the end game, but rather it can give the combined company a shot at an even bigger exit?
I think that's true. I think, you do talk about M&A all the time, and your audience probably knows that 80% of acquisitions fail to deliver double their value within 2 years, right? Which is, so you need to be very careful. If you're buying a company, you have to look for things like cultural fit. If you want the people, and that's usually where the value really is. If you want the people, you need to make sure you have a cultural fit, and you need to plan to do the work after the acquisition to integrate the companies, or you could be setting yourself up for failure.
Hold on, but one second though. Now, when it comes to like acquisitions and integration specifically, what are your views on that? Because I'm in healthcare, as you know, and it's specifically when it comes to like hospital mergers. Now, a lot of these things don't really go as well. Obviously, the merger, it goes well. They become a bigger brand, right? But for the patient, it doesn't really work out that well. I mean, on average, for a hospital merger, they jack up prices for the same exact service with no change to that service. They jack up prices up by 35%, right? And a lot of times that end up hurting the patients. The reason why is because, these mergers, these big hospitals, once they merge, they have more clout now. They could command more from the insurance company, right? But again, the patient side, it doesn't really work out that well. And sometimes a lot of people say, well, we're going to do bolt-on acquisitions. Okay, that's great, right? That's great. But you have to do, in my opinion, from what I've seen, you have to do a lot of research. Just because you offer one service here doesn't necessarily mean the other service that might be another component to it is going to be a great fit for you as a company, right? To bring that on just because, hey, this part A here goes with B. And if my clients or patients need this service, then they are going to need this service. And what happens a lot of times, these companies that do these integrations, bolt-on acquisitions, if you will, they end up just cutting a loss, end up selling it for a lesser price than they bought it for because the client or patient really don't need that service, right? Because they didn't really give the client or patient the reason why they would want to use that service. You can't just assume because this goes with this, I'm automatically going to want to buy it from you, right? So what are your point or perspective when it comes to integrations, post, acquisitions and mergers and stuff like that?
I think you need to look at all the constituents. You need to look at the seller and what their goals are.
Mm-hmm.
It could be it's a hospital that is struggling right now and there's no choice but for them to sell. You need to look at the goals of the management team. That's who usually benefits from these acquisitions. They get a bump in their bonus. You need to look at the goals of the hospital as an organization overall. You need to look at the patients that are affected. You need to look at the workers, the nurses and the doctors that are working there as well. To have a successful acquisition, you need to pull in all those pieces and make sure it's a win for everybody. And if you don't, the people that will succeed might be the management that gets their bonus, but then maybe they're not around 3 years later.
So there's no real longevity in that, right?
Right.
That's what I thought. Let's proceed.
Let me add on to that.
Go ahead.
I've noticed doing some research, a lot of private equity, a lot of large institutions, even corporations themselves, it seems like failure rates on acquisitions are at highest 40%, but the numbers really spike up when we get to the merger side of things, with failure rates going up to 80%. It seems like a lot of companies have the issue of combining two different environments, two different cultures. How can these businesses or these individuals looking to acquire another business ensure there's that compatibility with cultures in order to prevent that clash?
You need to do the work and the planning ahead of time. Cisco in its early days built their company on acquisitions. And they recognized something that isn't often understood by companies. A lot of times when you're acquiring another company, you're thinking, oh, they have this reach, they have this intellectual property, they have these customers that we want, and they forget about how that was developed. It's with the employees, and they forget about the fact, how am I going to integrate these employees? And so it's that kind of, you have to do that planning. You have to think about the employees. You have to think about the cultural fit. You have to have a plan. And you have, and again, you have to manage not to the acquisition, but to the integration.
Very smart. Now, there's some charts that show that slowly but surely startup funding deal sizes are shrinking. Let me share one with you. Len, it's quite intriguing to observe that after over a decade of growth, the typical funding deal size for a US based startup is witnessing a decline since the latter half of 2022. This seems to be a marked shift from previous years where we saw a significant jump in round sizes from seed to Series B in 2021, ranging between 25 to 59% year over year. How do you interpret this trend, and how might this affect the startup ecosystem?
I think the larger VCs wanted to invest in things that had less and less risk, but they were willing to throw a lot more money on it. I think we've seen movies like the movie about WeWork that showed how much hubris they had, and just, were buying this growth for growth's sakes point. You know, I'm in Chicago. I'm in the Midwest, and I think we've already in the Midwest, and there are statistics that back this up. We've always had more lower valuations than those on the coast. I think we're going to see the most shrinkage is on the coast, and not that you're going to see it here as well, and you're going to see companies that don't get funded, but I think the shrinkage is going to be less because Midwest valuations tend to be backed by more realistic analysis, because there's not as much money here flowing around. When you don't have the money flowing around on the coast, then you see a lot of shrinkage in valuation. So I think it's right. I think we're seeing those, and it's going to continue until the next boom cycle.
That makes sense. Now, as we progress through the decade, another fascinating trend emerges. The gap between median and average funding by type has broadened. This tells us that larger rounds at each stage have become more commonplace, causing averages to rise more dramatically. From an investor perspective, does this indicate a shift in the investment strategy, leaning more towards larger bets?
I think it shows that the large venture capital funds are picking up money from pension funds and their other funders, and needing to put that to work. And so they focus on companies that they have less perceived risk because they're further along. I think that leaves the traditional funding for early stage companies in an even deeper hole.
Great. The data seems to suggest that we won't return to the funding levels from a decade ago. However, the uncertainty lies in whether round sizes will shrink back to pre-pandemic levels. As of now, only Series C has dropped below 2020 levels and is still above the 2019 median and average round size. But as the market continues to adjust, startups at earlier stages face an uncertain future, particularly if late-stage funding continues to contract. How do you foresee the future of startup funding in the wake of these trends?
It's hard for me to say. I think that for good startups, there can always be funding out there. And by good startups, I mean, the smart investors look at the jockey. They'd love to get an A team and an A quality company, but they'd rather have an A team and a B quality company than a B team trying to make an A quality idea work. Now, sometimes that means they invest anyway, and then they invest with terms that enable them to switch out the management.
Right.
But it's going to be a factor, and if you don't have one of the better ranked ideas with a better ranked management team, then I think it's going to be much tougher going.
Great. Look, so real quick, right? Just perfect segue into our next section. I want to talk a little bit about what you're doing over in Chicago, and what you put together. I want you to talk about that with your company, Concept Equity. Let's just talk about that a little bit, and tell the people about what is it exactly, and how did you come to find Concept Equity, and let's just dive a little bit into that.
Yeah, well, again, it's because I love providing insight that accelerates entrepreneurial growth.
So what do you so what do you do at Concept Equity? Like, what is it that you do?
So we prepare entrepreneurs for investment. We provide strategic and financial advisory services. We've helped entrepreneurs get loans. We've helped them raise money from VCs. We've helped them recognize they didn't have the right people on their team and they needed to change out some of those people. It really, it surprises me. So I remember going into one meeting, somebody had hired us on retainer to help their company. They were thinking raise money. And we were thinking we need to understand the company and we need to find out what's going on and what opportunities and challenges they're facing before we can help them. I remember walking into the meeting, being a little bit scared that we weren't going to find the thing that was going to help them. And we walked into the meeting, we started talking to them, and companies actually know what they need a lot of times. So we found out that the management team, that the senior management thought that one person they had on the team they didn't really need, and that person didn't want to really be there. We talked to that person and they didn't really want to be there and they weren't helping. But neither one of them wanted to let the other one down, and so that person was still there. They just needed somebody from the outside to look at it. We helped them realize that that person needed to move on to their next opportunity, and it was actually good for both of them. We also identified that they had a gap in their technical knowledge, and we found an amazing candidate for them, and they were able to add that person to the company.
Okay, so you're saying that or do these companies have to be in what stage, and how much are you looking, like how much do you work with these people to raise minimum and a maximum?
So we also run Business Network Chicago Venture Forum. We have 3 entrepreneurs pitch every month, and I'll talk a little bit about that. For that pitch event, we look for early stage companies raising $250,000 to $5 million. We look across all industries, and we're not trying to do real estate deals. That's not what we're about. It's usually companies that have some kind of unique competitive selling proposition that gets us excited. And so that's companies 2.5 to 5, 250,000 to 5 million. Because of the work I do at Nanogas Environmental, I also see incredible environmental opportunities, ESG companies, environmental social governance, emphasis on the environmental, whether it's hydrogen or solar or some kind of other clean tech, cleaning water or whatever it might be. I see a lot of those companies, and a number of those companies need a huge amount of money. We're talking not about 5 million, but 100 million, 800 million. And I've got some connections for those kinds of companies as well, especially with the way the government has decided to allocate money and help fund companies like this. It's created more investor interest as well, and so there's a lot of interest in getting those environmental projects done. So either the 250 to 5 million or the environmental projects that can sometimes run into the hundreds of millions of dollars.
How often?
Yeah.
How often do you see like these bigger budget projects as opposed to the smaller 250 to 5 million raise?
I see, we talk to more than three companies every month. We screen them out, and sometimes they screen themselves out. And we see the big projects. I would say maybe 1/10 or 1/20th of the companies are the big companies. But we have some funding sources for those, so we're interested, and I like making a difference in the world. So I like that aspect. But I'll tell you, on the companies that are raising 250,000 to 5 million, we have kind of we've been having them pitch for 18 years. And in that time, what we found is that entrepreneurs were not putting their best foot forward. They were asking for $1 million, and they were not communicating their value to investors in the best way. And sometimes it was so bad that they would embarrass us when we put them in and allow them to pitch. So we finally came to the conclusion that we had to coach all the companies on their presentations before we would allow them to pitch. And we came to the conclusion that even though for these companies $500 could be a lot of money, we still needed to charge $500 for a service that should cost $2,000, where we coach them on their pitch. And we end up creating a huge improvement in their pitch with them, maybe providing some strategic advice. But the typical investor has ideas of what they want. We all know what goes into a pitch deck, but we don't think about how an investor thinks, how anybody thinks about making their decision when we put these decks together. And we teach people more, how do you think about how the person who's listening to you is thinking about what you're saying in order to make your pitch more valuable.
So is this kind of like a Shark Tank? And Valentino, you could hop in anytime, right? But is this kind of like a Shark Tank type of thing, or what is it more kind of? Because Shark Tank is the only thing I know that's like this, right? So we're live pitching to these people, right? To these investors in person.
Yeah, they're live pitching. Our event is open to everybody, so they can't actually make an offer to investors during our pitch. That has to be in one-on-one meetings with investors. So their goal is to get those one-on-one meetings. But if the investor has a hard time understanding how great your management team is, if they have a hard time understanding what your product is, why the customer will buy it, what's amazing about your management team, how the company's going to make money, what kind of traction you have, and how the investor's going to make money, it's going to be harder for them to invest.
Okay. All right. So just walk me through this, right? Let's say, all right, Blue Horizon Industries Holdings, we decide to say, hey, Len, we want to do this. How is it? Is it just that easy? Hey, look, I decide that I want to be part of it, or is it something that you guys do perform due diligence on the background of the company and decide which ones you pick, being that you only pick 3 a month?
Yeah, we don't do due diligence. We've seen a lot of companies. We do an initial look at their deck to see if it makes sense for them to pitch. Then we'll select 3 companies, and I work with Lauren Minkus on that. Lauren's my partner in making that selection. Just a little bit of Lauren's background. He was secretary for the investment board for Motorola when they were Motorola before they got split into all these things.
Mm-hmm.
And all the pitches would come through him while he was at the company. And he was also responsible for monetizing all their non-strategic assets. And he sold off 300 of their investments, generating over $2 billion in cash for the company. So Lauren usually looks through the pitches to decide who we want to present and who and whether we can even take them on. Some people, we may have a slot open and we want to take companies on, and Lauren will look at the company and we'll say, oh, we just can't do it. We prefer to get companies that have revenue, unless they're, let's say, a life sciences company that may never have a product in the market before they're acquired. We prefer to see companies with revenue, and we help entrepreneurs think about, well, how can I get just a little bit of revenue to prove that there's a product market fit, to prove that somebody will pay something for my product? And so we like companies like that, although we do have companies without revenue pitch at times. But then we'll select the 3 companies, we'll coach them. And this is where I think we could really get some insight. So we coach them. You can see on our website, which is bnchicago.com, you can look at our presentation advice. We give it all away. So you could just see it. You could go there. You could watch a video with it. We also have training infographics on how to do that. So you can do that, but I find that there's nothing like having some help to make it simple, get a simple core message that everybody can understand, because as entrepreneurs, we're all cursed with knowledge. And so even when I try to pitch my own company, I'll take it to Lauren, my partner, and he'll go, "Man, what about these principles that we tell everybody to do? You forgot." So we all need that reminder. We all need that help. The beautiful thing is, I think that gives us insight into what are the good companies, because when they present, we get to see whether they followed the advice that we laid out for them. And some of them are coachable, they can, and I think those management teams are more investable. And some of them, it seems like it fell on deaf ears, and it's good to know. And then, it's the ones that are coachable that we want to take on to and work with further in finding investment.
I got a question. In regards to all these individuals you've coached and assisted throughout these years, what would you say are the top 3 industries in the past 3 years that investors have really put their money into?
I don't think I think you get investors from all different fields. So I think there's always an interest in life sciences companies. There's an interest now in, the frothy market right now, I think, is artificial intelligence. A year or 2 years ago, the frothy market was cryptocurrencies. Now we've got companies that are providing real value using blockchain as a background to build their company. And we're advising them, let's talk about what you do and what value you bring, instead of talking about the fact that you're going to use an NFT, for example, because now we think investors are very wary of that. And we have a company coming up on Tuesday, which is our next pitch, and anybody can attend. We do it over Zoom, and we have next week is our first time we're going to be hybrid, face-to-face, going back face-to-face after the pandemic. And one company is everything you think about in terms of taking advantage of distributed finance and taking advantage of blockchain and some of those things. But the real value they're delivering has nothing to do with that. That's just the rails they build on.
Right. Now, as far as the individuals you work with, would that be anybody as long as they meet the criteria, or is it a certain type of individual you're looking for?
Well, it's anybody, as long as they, anybody who's 250,000 to 5 million who has a good idea and a decent management team. Sometimes we don't know how good the management team is until we coach them, right?
So basically,
yeah.
real quick. So basically, any member of our audience could just basically reach out to you and say, "Hey, Len, we'd like for you to help us with pitching investors." It doesn't necessarily have to be they're coming on your show, particularly, right? It can just be, "Hey, we just need help pitching with investors." Is that right?
Yeah, and we've done that. If they're not going to be pitching at BNC Venture Forum, then we charge closer to the $2,000 that our coaching would normally cost. Yeah, because it's we're putting in it's significant time we put in to help them. When we help companies, it's not just the time we're spending with them, but we say, look, send it back to us again. Give us your first draft, your second draft, your third draft until it's right. We really like to see companies succeed.
Okay, so sorry about that, Valentino, real quick. So our members would have to have some kind of business plan, pitch deck together, obviously a team, right? A management team.
Yeah, at the very least, you need to have advanced the business to the point where you're close to revenue or you have revenue, again, assuming it's not life sciences, and advance the business to the point where you know what your projections are for the from where you are now until maybe where you might exit or where you might continue on the operations of the company. So that would, if you haven't built, let's just take one example. If you think your company is going to take 5 years to exit, if you haven't built 5-year projections, then there's certain things you're going to be missing. You're not quite ready. You should have that built. And you should go have your business model canvas built. And if you don't know what that is, or you're not sure, or you have some questions about how to work on it, then there's a fabulous free online class taught by Steve Blank, who's the entrepreneurship professor at Stanford, called How to Build a Startup. And it's on udacity.com. And it takes effort and time to go through that class. It's a regular 40-hour class that has homework, but I highly recommend it.
I got a question in regards. Say somebody has a SaaS product they're looking to take to market. This is pre-revenue, but it does have a substantial user base that they could eventually turn into paying users, right? And they could forecast that. Is that something you take on?
Yeah, they have traction. If they have those users already using their product, the next step is, okay, can we get them to pay for it? All right, something. Or are we selling ads? How are we gonna make a little bit of money off of that? Because an investor's not in it, to build something cool for free.
Right.
They're in it to if they invest money, they want to expect a return on their investment.
Right. Not everybody's an innovator. With that said, there are individuals that are looking to buy companies, and acquisitions, merger and acquisitions, is a part of our topic. Is that something you assist with? Raising capital for mergers and acquisitions, acquiring a business,
Or at least helping with the pitch.
Yeah. We think it's the same kind of. Are you asking? Well, the answer is yes. We would help on the side of the company wanting to acquire companies. We would help on the side of the company wanting to be acquired. It's more likely that we'll get involved with a company that wants to be acquired, just because those are the smaller, ones raising the smaller amounts, like we talked about. But it's all of the above, and we're interested. It's about, can we provide insight? Now, I think that a lot of the private equity groups out there, they believe they have that insight already, and that's what makes them special. And so, if they're the acquirers, they probably have their team of people that they want to use to do that work already. But if you want to be the entrepreneur and if you've got the company and you're trying to figure out, I want to be acquired, I want to get a nice exit, how do I increase the value of my company so that I'm more attractive for an acquirer? That's something we can help with.
In regards to these businesses, what does the typical management team look like? Would this include CEO, CFO, chairman? Give us a run through of how they look and how do you structure them?
That's the really interesting thing. When we had entrepreneurs pitching, we originally thought that what they needed to do was have a management team and know what their gaps were. Who's the CFO, who's the chief operating officer, who's the chief financial officer, who's marketing, and who's running the company. What we found was that that's not what angel investors and VCs were focused on. They wanted to know that the management team was great rather than whether the management team had gaps. You can fill the gaps, all right? But they wanted the people there to be amazing. So we started changing our pitch advice. Instead of saying identify who's filling each spot and what are the gaps, tell us about what's amazing about your management team, because that's has impact, and that has is more emotional, and that's why people really buy. People buy, even investors buy for emotional reasons.
1 second, real quick. 1 second. Sorry about that. So what should the management team look like? Again, it has to be great as opposed to filling gaps. We understand that. But at bare minimum, what should that management team look like? Are we talking about having the CEO, obviously the person who's going to grow the money, right? Have that experience, the CFO, the person who's going to manage the money. Okay, so aside from that, what are investors looking at, right?
Think about it a different way.
Mm-hmm.
You want a founder, the person with the idea, who's a kind of an inventive person. Inventive people are generally not great business people. Steve Jobs wasn't the inventor, Wozniak was. It's there. So you need the best companies, and I know some investors say, I want companies with at least 2 people on the team. And the reason they say that is because they want an inventor, and then they want somebody who's good at business, right? So rather than saying, oh, they have to have a CFO, or you can get a fractional CFO,
right,
you can get a fractional CMO, you can get I don't think it's quite so easy to get a fractional chief operating officer. That kind of person it can really help your team. But think about it, if you're the inventor, think about how do I get somebody who's good at operating and managing a business to help me out. If you're somebody who's good at operating and managing a business, think about how I can partner with somebody who's coming up with great ideas that we can create a business out of.
No, that's really great, because I see a lot of people that we talk to on a daily basis, and we talk about this a lot because a lot of people going after the capital raise, I advise, hey, look, put a team together, because a lot of people think they could do it by themselves, right? Rather than have experience in that industry or not, which is kind of crazy to me. But they want to be a one-man army. And I usually say, well, don't do that. Put together a team, put together a solid team. But I usually tell them, very similar to what you just said, but not quite there. But I usually say, get a management team and get a really good CEO, but a startup CEO, right? Because we have different stage of CEOs, but you need a startup CEO that has, experience of growing companies. And that guy is really going to ask you some interesting questions. He's going to frame things in a certain way. Kind of like my CEO, right? The first thing he asked, he was like, Unsi, the first deal you're going after, is it the best deal? And if it is the best deal, well, okay, so first of all, he was like, the first move you're making, is it the best first move? If it is the best first move, why is that the best first move? Right. And since he asked me that question, that's something I've carried with me. I'm like, oh, wow. And anytime we look at a deal or anytime we look to change anything, I'm like, is this the best move? If it is, why is it? Right. So you have to have a really good CEO. But going back to my point, I usually tell people they need a management team and at least a CEO and CFO if they don't have that background, because you're not selling yourself, you're selling your team. You're going to use your team to sway investors to raise capital.
When you are, maybe it's a couple kids coming out of college that are establishing a new business,
Mm-hmm.
and they've got an amazing idea, right? Maybe it's them. If you don't have the great management team, then think about having an advisory board of people that can get you going in the right direction along the way. So whenever somebody is pitching, is putting their pitch together, and it's clear that their management team is not that experienced, that doesn't mean they're going to fail. That doesn't mean they can't have a great business. That doesn't mean they can't lead a great business. That just means they need some advisors that have real talent, especially, somebody from their industry, somebody who's been successful at startups, somebody who has been successful running businesses is on your advisory team. And even better if they'll invest as well. But recruit that advisory team, and then when you present to investors, you can talk about your advisors as well and what they bring to the table.
And lastly, sorry about that, Valentino. Lastly, now a lot of people have, I say it's a fantasy. They're in fantasy land. So a lot of people think, hey, look, I have this great idea. I'm going to raise capital, not having any experience in that industry. I'm going to raise a ton of money, right? And they think they're going to do one capital raising round, raise probably a few $1 million. And then from there, they're like, we're not going to need to raise any more capital. And I have a 5-year plan, and I'm going to exit with 65% ownership of my company. And they want to exit at $1 billion. And I'm like, do you hear yourself? The only person I know of that owns like his company 100%, correct me if I'm wrong, Valentino, but I believe it's Dyson, Sir Charles Dyson, something like that.
Correct.
The owner of the vacuum guy, right? He's the one person I know of that owns a $1 billion company, and he owned that much ownership. He retained that much ownership. So I think a lot of people are being delusional if they think that they're going to do one investment round. Keep in mind, these are people who want to build an acquisition platform. So they're not trying to buy one business and flip it, exit in about 2 years or so. They have a 5-7 year investment horizon. They want to buy about 30, 50 companies and think they're going to exit with 65% ownership. I don't see that being the case from my experience of talking with investors, right? Doing capital raises, a couple rounds. That's not have been the case for me. What is your experience as far as that? What would you say to someone who come up to you and say they're going to exit at $1 billion, but they think they're going to retain 65% of ownership of the company?
They're going to need more rounds. They're going to need more rounds. And they're going to give away more of their company for that, unless they can qualify for debt. I think entrepreneurs often don't think about other alternative sources, grants, debt, something else. The best place to get money is revenue, right? The second best place, well, what if your vendors or your customers could pay you to build what they want, right? So there's opportunities to bootstrap, but if you're going to be on an acquisition route, then you're especially if you're acquiring companies and you only have 2 million, that's hard for me to think how that's a successful strategy unless you're going to bring in a lot more. I'll tell you though that so for example, my company, Nanogas Environmental, we have a raise we're doing right now. You should be raising the amount it takes you to get to the next major inflection point that makes your company worth more money, and then raise more, right? Mm-hmm. Unless you don't need it, unless you can justify, I can go to the bank or I can go to a secondary lender, get all the money we need, afford to pay the interest to grow my business. If you're acquiring companies, then banks might work with you a little more if you have a good base, a good foundation that they can lend to. All right. So the other strategy, back from the early 80s is to leverage the heck out of things. And if you're great at it and you're successful, leveraging can really create a huge business, leveraging with that. But it increases risk because if you miss out on that cash flow forecast and suddenly you can't cover the interest, you could lose the whole business.
Of course, it's always a risk there. So I guess it comes down to risk versus reward, and probably how fast or how slow you want to go. That may have, some kind of factor into that may play a factor into that, maybe. But ultimately, I think it's risk versus reward. I think for when it comes to leveraging debt, that's a really great idea. It increases your IRR, right? But it's just, I think sometimes entrepreneurs like myself, we're a little bit sometimes too enthusiastic, but in other times we just don't really realize how much it's going to take to actually bring the vision to fruition. Because capital raising, a lot of the mistakes that a lot of people make, especially people new to capital raising, is not asking for enough. So you may go in front of an investor and say, well, we're going to need about 5 million. And you're talking about a really complex plan. They're going to look at you and say, well, you're going to need about double or triple what you think. And sometimes because of that, people lose out on that capital commitment from the investor, and it signals you don't know exactly what you're doing.
Well, the other thing you have to be aware of is that the investor might know this in the back of their head, you're going to need more, right?
Mm-hmm.
And so they might put provisions in their investment strategy, in their offer to you, things like control of the board, things like being able to invest more money if the company goes out for more money, so that they get to a position where they're a majority owner of the business. If they really like your business, they may still do that. And they might not tell you because they might say, look, I've seen this thing before. The company doesn't know, but I'll be prepared for it. That's why a lot of venture capital funds, you hear about how they have money left. They call that dry powder because their companies end up needing more money than those companies think, and they have to be prepared to support them. Especially when a Silicon Valley bank
Mm-hmm.
goes under and all of a sudden the loans you were going to get from a Silicon Valley bank aren't there, and then your investor has to be able to stand in, and you end up giving away more of the company.
Yeah, of course. No, absolutely. I agree totally. Valentino, you wanted to make a couple points.
Yeah, absolutely. I'm gonna divert a little, but it's essentially about AI. As you know, we have ChatGPT. ChatGPT 4 just came out, and is proving that artificial intelligence is becoming incredibly rapid in development. And because of this, there's a lot of people that are fearing loss of jobs. With that said, that also creates opportunities. So how could this lead to either an increase or decrease in investment banking? In the regards of artificial intelligence has data that is limited to such degree, but in the future, they're going to be building their own models with their own data, including market data, and it's going to be able to automate a lot of repetitive tasks, minimize bias, and also involve predictions to a certain degree.
We're acting as though artificial intelligence just arrived on the scene. It's getting in the press now, but people have been working on it for 30 years. I remember a friend of mine now, his company was acquired by a private equity company, and they liked him as a manager so much that they put him in charge of a combined entity that controls multiple businesses that had similar characteristics to his. But I remember it was probably 1980. He was trying to use a neural network to figure out, what stocks to buy. Right. So it's been around a long time. There are some models that are very advanced. I think that there are some financial houses that have been using artificial intelligence and haven't been telling us because that's how they're making their money. It's just ChatGPT hitting the headlines and reminding us that this is a big deal, and getting advanced enough where it's really starting to make a difference. And I think the number one thing that if you're an entrepreneur, or even if you're an investor, you need to be thinking about is, how can I use this to leverage what I'm doing, right? Instead of saying I'm an artificial intelligence company, I'm a whatever company. How can I leverage what artificial intelligence can bring for what we do, right? So it should be part of the infrastructure. And in terms of jobs, I think we all always need to be thinking about keeping learning, because we're not going to school or going to work and learning new things. Those aren't the last things we're going to have to learn. We're going to have to reinvent ourselves multiple times, and this is just an acceleration of that process.
Real quick, a lot of people say, okay, so obviously we've been using AI for a while. And to your point, maybe some of them we didn't know about, right? And it's not relatively new per se. But that being said, I mean, don't you think we're going to see at some point, because given the rate that ChatGPT is growing, right? And Valentino, I want your perspective on this too. You use ChatGPT a lot, and you have some kind of cybersecurity background, so I want your input on this. But given the rate that ChatGPT is growing, I mean, from 3 to, I guess, what, 3.5, Valentino, to 4, version 4. I mean, it's exponential, right? But again, I do recognize that ChatGPT is a language-based model, right? So maybe there are some hype where it probably shouldn't be, but I mean, it's taken test exams and it's passed. Shouldn't that raise some kind of flag? I mean, like, what is the 5th version going to be? Like, what are we looking at a year from now, 2 years from now, 3 years from now? Elon Musk, he's been kind of vocal on his thoughts about AI. Like, we should be careful, how we unleash it, stuff like that. How, we should not give it the capability to replicate itself or program itself, right? Because it'll get exponentially better very quickly. That's the danger there. That's what a lot of people are saying. Is that really the case with ChatGPT? And again, like Valentino, I really want your perspective on this as well, given your cybersecurity background. Like, what are you seeing the change, or is there any real threat to the landscape or the working environment? Are there going to be people that are deemed unemployable?
Yeah, let me hop in there. I think in regards to data and privacy, everybody's concerned about who's going to hold the data. But now with efforts of trying to make AI open source to such a degree where people can host their own AI and upload their own data and maintain that data, we're going to see nothing but an innovation. A lot of people see it from a first world country perspective where we're using it as leverage, but we also have to take into account that this is giving third world countries and third world people access to first world data and advantage, right? Mm-hmm. Before, I'd argue back in 2020 when I was starting to study finance, it took me about 6 months to build my first financial model, and I thought it was impressive until I had a financial analyst take a look at it and told me it was half wrong. Now with the use of artificial intelligence, it took me 4 hours. All I had to do was ask what the formulas are, what's its usage, and then I just plugged it in Excel. So this is giving third world countries a competitive advantage, right? In the future, I might say in regards to jobs, lower level jobs are going to be lost, but it's eventually going to put the focus into advancement of humanity, right? If we stop spending so much time and effort into little things, right? And it usually comes down to research. Research takes hours. It takes days, years, months. And the lack of information or misinformation can also be solved through it, to a point where we could start using that information and building on it. Now, what are your thoughts?
I think Len has different opinions on that.
I want to tell one story. So this is 18 years ago. I should have responded with this first. 18 years ago, that first company that I started working with, when I'd been in sales, VP of sales, The first company I started working with had a natural language semantic model, basically artificial intelligence, where they said they could use it to read and understand a real estate lease and manage that lease and tell you, answer questions like in this big building, who has the right of first refusal to the space that just became vacant? Right? Those are tough questions to answer unless you know all the leases in the whole building and all the clauses in them. And you can't answer that with the way the real estate industry was doing it at the time. I don't know what they're doing now, but you couldn't answer that at the time because they were just using a database and scraping off the least certain fields and putting that into a database. It didn't include all the clauses that were written into the lease, and nobody knew what was in all those leases. So it could be a lot of value. The models now could do a much better job of that. Another thing they were thinking of doing with it was gathering together all the research, all the medical research, and being able to start doing the research using a great engine. And I think we can see huge improvements in the speed and the rate at which we make medical technology breakthroughs because somebody's done it before. Somebody's done information before that can help out. Are there going to be people displaced? Not just low-level people, but mid-level people, people that are writing PR, for example. There's absolutely going to be people like that displaced. They're going to have to reinvent themselves, learn new skills, just like happened in the Industrial Revolution.
Yeah, but do you really think it's going to be like the lower level people, or is it going to be the higher level? What I think, it's really going to be like the higher level people first, like the more complicated jobs, and then because a robot right now, like Chat GPT, can't like plunge your toilet, it can't clean the bathroom, right? It can't do janitorial work. So I think it's higher level people who's really at risk, and then
I think it's going to affect. Yeah, I think it's going to affect both. I think it's going to affect white collar jobs, right? Because what's that actuary doing today? Is that something that we can get artificial intelligence to do? Right? Those types of things.
What are your thoughts, John?
I got a question, but it's finance related. I don't know to what extent you're using AI in order to analyze your investments, but one of the jobs that are in the list of danger is financial analysis. I mean, I've done financial analysis with ChatGPT, and it does pretty well so far. What is higher level to add, or what's something that AI cannot do that it has to be necessary for us humans to do? Is it the reasoning side of things? Because it seems like it could do analysis without an issue.
Understand that there's black swans, right? So you're training this AI model on historical data, right? So what happens now when there's something brand new that happens? That's when the financial models fail. That's when we get the huge depressions or recessions because there's something new that wasn't planned on before. Will they stop some of those? Maybe, because there will be less emotion involved in making the decisions. But on the other hand, there's no accounting for brand new change in how things work that can impact everything. So it's like, what is the data set, right? Knowing what all the population of all the questions that could go into the LSAT could be, right? Go into the bar exam could be, that enables the artificial intelligence to answer the bar exam, right? But what happens when there's things that are brand new? So I think there's still going to be a role for people doing those kinds of things. And we'll just learn different things.
I got another question. It's more of intelligence, so to speak. Now, as the generations grow, people eventually become dependent on certain technologies, right? Baby boomers didn't have the technology we had now, so they had to deal with what they had. With that said, new generations coming up are going to be at the forefront of technology, and with AI being more prominent, and we still have 5-year-olds, 6-year-olds, so on and so forth, they're going to eventually start using it in school. Do you think this is either gonna affect or speed up the rate at which they learn? Meaning either they're just keeping up with the AI and they're always behind the AI, or do you think they're still gonna use their research abilities and go and try to dig deeper and find, more meaning to things?
It all depends on the teachers. And by that, I mean, AI can train us how to teach better, what works for people, what works to teach people better. We know the principles to teach, let's say, math skills better. We know it's not, we're not, the US is not falling behind in teaching math skills because other countries are doing it by rote. They're doing it better. They're teaching better. They're methods that we can understand, that are well understood, that we could be applying ourselves, and we're not. We could look towards AI to help us learn that stuff better. And so I see that as an opportunity. I think, every year I feel a little bit more like a Luddite. I mean, since I had some systems background, I'm not afraid of new technology, but I'm very practical. I just use stuff that I find, okay, I need to use now. So I haven't been playing around with artificial intelligence myself for years and years. But ChatGPT is here. Am I dipping my toe in and trying to get it to answer some questions and see what I get back, see if it's any use? Yeah, and I think we have to continue to do that.
Will you be will you be using any kind of AI with respect to BNC and concept equity and kind of like helping with the pitches and stuff like that? Do you see that as something that your company would benefit from?
Yeah, certainly. I mean, if there's AI that can help people build financial models, that's fantastic, and I'll have to learn about that. But if we think it can make a difference, yeah, we'll adopt it. The every time I read a new book and I learn a new concept that can make a difference in how people present, I want to incorporate that in the advice we're providing for people in their presentation. I think that any VC who's not looking at AI to help them do due diligence and analyze their companies they're thinking about investing in is probably missing out right now.
For sure, for sure.
Yeah, let me come in there. Deviating from the topic of AI, let's circle back to investing. A big part of investing is risk, right? So, as an investor, how do you assess risk? What are your like 4 cornerstones to assess a deal is worth moving forward with?
Frankly, I want to get excited about an opportunity, right? And it at the very basic level, there are risks, and let's look and see how we can manage them. And again, I want to make sure we do the due diligence to understand, is there investment risk? Is there, who owns the company? Is it managed right? Are we going to get, does somebody have a clause in their investment agreement that's going to secretly control the whole company, even though I don't know it? Do I need to look at those? Maybe I could use AI to look for that stuff. But those kinds of things I want to know. I think in general, the risks of the company are not that difficult to discover. But, I would say do your background check on the management team, do your background check on the company. We had one company that presented at BNC. Loved their idea. I liked their idea. Wanted to see it taken out to investors. One of our investors invested, and he found out that that there was another owner who had senior rights, and he lost his whole investment as a result of that. So, but he could have known that at the time he made the investment had he done his due diligence. Let me cut it off there. If you want to dig into that question some more, because I'm not sure I even answered your question.
Yeah. I don't know to what extent you're involved in the analysis of these deals. Maybe you have somebody that does that for you. But with that said, myself, okay, I need you to agree on a statement. Agree or disagree? Is valuation biased?
Yes.
Okay.
Of course.
With that said, myself, I do have a bias. My bias is I like to be more risk averse. I like my investments to ensure security of cash flows over a long-term period. I don't like many assumptions, right? So with that said, I've heard people say the value of the business is it's its cash flow divided by its risk. And by risk, I mean, say the business is making about $1 million in revenue, right? And say from that revenue that's generated is between 100 customers. And say 3 of those customers make up the concentration for about 60%. And then one of those 3 account for the majority, let's say 30%, right? With that said, say that is on a contractual basis. And that contract is going to expire next year. But we reach out to the customers that have that contract and we ask if there's a possibility of renewal. They say no. And they want to end the contract, right? So I want to account for that risk in cash flows. I don't want to assume I'm going to be making that $1 million for years to come. I like to dig deep and account for that risk of cash flow. How deep do investors dig in regards to that?
Not deep enough.
Okay.
That's my answer. I mean, I think you're talking about rational decision making, and good investors have their list, and they reach out and they find out about those customers, and they worry about the concentration of customers, etc. But I think, especially in the angel arena, you get a lot of people investing with their heart, and I like that because we get a lot of great businesses from people investing with their heart. But I don't think they spend as much time looking into the details. And they find out there's competitors they didn't know about. They found out there's an investor that with certain rights they didn't know about. They find out that they're going to lose a key customer and all of those things. Maybe they could have known ahead of time. So so get a great due diligence list if you're a buyer. If you're an investor, if you're a buyer, and it's not rocket science. We can get a list that tells us what are the risks that we need to watch out for, right? Just do the work.
Right.
Yeah.
Me personally, like I said, I like to dig deep. But at the end of the day, I feel like it's my responsibility. To some
It
degree.
is, but
Mhm.
but how do you know which companies to dig deep on? You have to look at a lot. You're looking at a lot of companies. You don't have time to dig deep on every one of them. So what I think the entrepreneurs are trying to figure out is how do I get to the point where I'm one of the companies you're digging deep on? We'll together come up with how do we manage the risks, right? But I want to be one of the ones you're digging deep on. And the way I get there isn't the way most people think it isn't the way most investors think they're making the decisions, and it's not the way most entrepreneurs think the investors are making the decisions. People make their decisions for emotional reasons. And you have to talk to the emotion to be one of those you're going to dig deep on. If you're going to dig, maybe you're one of the investors that doesn't do that much digging, and then you'll invest based on that emotional decision. And by that, what do I mean by that? I mean that our emotional brain is 5 times stronger than our rational brain. If we start getting analytical, if we allow the investor to get analytical early when we're pitching our company, then we're going to take the emotion right out. They're not going to invest, right? So we want to, even though we think there's core information they want to know, and we have to deliver, and we have to do it well. Again, we ask entrepreneurs to answer 6 questions when they present. We think every investor needs to know the answers to these. What's the product? Why will the customer buy it? What's amazing about the management team? Because if I'm going to invest in A management teams, I better hear some amazing, right? How does the company make money? A lot of times the entrepreneur hasn't thought that through well enough. What kind of traction does the company have? And how does the investor make money? And I would say about 90 to 95% of the time, the entrepreneur isn't prepared to tell me how the investor is going to make money. And one of the most things they're most unprepared about is they haven't selected and chosen a valuation model for their company. And maybe they don't understand how to do that. So when we coach them, we teach them how to value their company using an entrepreneur-friendly model, which is the venture capital model. It's basically based on future cash flows. And we make it simple for them to do that. And then that gives them, if you're doing that, then that gives them a basis to communicate with the investor and start discussing valuation because it's built on projections.
Mm-hmm. Mm-hmm.
Is that model?
How you feel about that, Valentino?
I got some pushback in regards to valuations.
I know you do. I know you do. I'm looking at your face.
I'm hard-headed, but
I've heard of 2 investors that say, "Oh, we don't want to know that. We don't tell us how we're going to make money. We're better off. We can figure that out for ourselves."
Oh, okay.
And when I hear that, I hear an investor that wants to cut a better deal than the entrepreneur wants to give them. If the entrepreneur only knew what they were worth, then the investor couldn't take advantage of them as much. And I think that's why the investor doesn't want to know how the entrepreneur is thinking about how the investor is going to make money.
Yeah, but does that really? Okay, so who does that work? To whose benefit does that work in a way?
It works to the investor's benefit.
Of course. So now, how often do you see this happen here?
I see the entrepreneur not knowing how the investor makes money better than 90% of the time. In other words, only 10% or less of the entrepreneurs that we see come in with a pitch where they can tell us, here's how much money we think the investor will make if we hit our projections.
So are you looking at base case, worst case, or best case scenario? I mean, typically, I don't really discuss our best case scenario. That's wishful thinking, kind of, right? So
here's what we tell people. First of all, every entrepreneur tells every investor, my numbers are conservative.
Yes,
absolutely. And every time the investor hears that, they say, well, this is hogwash because nobody hits their numbers, right?
Mm-hmm.
So immediately when the entrepreneur says my numbers are conservative, they lose credibility, right?
Why is that though? Why is that?
Because the investors heard it before. The entrepreneur before them said that, the one before them said that, the one before them said that.
So is that something that's impossible? A entrepreneur can't be conservative?
You can, but I don't think you should. Here's what we think you should do instead.
Okay.
Choose the highest numbers for your projections that you're willing to bet the company on. The highest numbers that you're willing to bet the company on. Here's what we mean.
That's interesting.
Let's say the investor comes in, you've got your model, you've chosen a venture capital model, you said, here's my projections. and so my company's, let's say post money, my company is going to be worth 10 million. And the investor goes, no, post money, I think your company's only going to be worth 5 million. If you've selected the highest numbers you're willing to bet the company on, then you could turn around to the investor and you say, okay, you can invest at a valuation of 5 million. But if I hit my numbers, if I hit 80% of my numbers, then I get to claw back your ownership, so you only invest at a valuation of 10 million.
Really?
All right. So that means now we have an opportunity for the investor and the entrepreneur to talk. For the investor, that's great because they either get the company at 5 million if they don't make their numbers, or they get the company at 10 million, but the company's doing great. So why wouldn't they want to have it at 10 million? Right. And for the entrepreneur who chose their numbers, they're betting on their company and they're betting on that valuation. So now they have something that's really, they should feel good about because that's the numbers they were willing to bet the company on, right? That's how you should choose your numbers, not the conservative numbers. Don't cut them down for the investor who wants to cut them anyway. Not the ridiculous numbers that are going to be hard to reach, the stretch numbers. The numbers you're willing to bet the company on. Yeah, you could do multiple different models, and you could have your worst case and your medium case and your best case, and that's another approach. But I think if you're thinking about what are the highest numbers I'm willing to bet the company on, and you get a disagreement with the investor, then you have an opportunity for discussion to say, well, you know what, I'll give you yours, but I get mine if we perform to those numbers, or if we perform 80% of those numbers.
Mm-hmm. Yeah, that makes sense. That makes really, really great sense.
And I only saw Shark Tank do that. Robert Herjavec actually suggested that for an entrepreneur one time. But if I were an entrepreneur on that show, I'd be going for that all the time. Frankly, I think, Shark Tank, they're valuing these companies as though they are private equity companies, not growing like a banshee like they should be. And I don't think the entrepreneurs are getting a fair valuation.
Mm-hmm. Right.
Okay, I got a question in regards to a model. You mentioned projections. You mentioned these high numbers. I'm assuming these are pre-revenue companies.
Post revenue, it doesn't matter.
Okay. Post-revenue companies forecasts are based on historicals. So there's just so much you can assume in regards to future growth.
You're talking about, later stage companies. If you're talking about valuing later stage companies or mature companies, it's a whole different thing. A mature company, their increase in value, how much is a private company worth? Let's say 5-10 times EBITDA, for example. Well, how much is it worth if it's listed on the stock exchange? Well, if it's part of a big company, it might be worth 20 times price earnings, right? Mm-hmm. What's the difference? What's the difference between those companies? The difference is governance, right? The difference is operational setup and governance. Do you have the management in place? Do you have the governance in place? And so if you can take a company that's private that might be worth 5 times EBITDA, and you can get the governance in place and all the procedures in place, so if they lose a manager, they can just replace him. If everything's there, then they could be worth a public company valuation. Now, if you're playing the mergers and acquisitions game, and you can have a public company, or you can buy companies until you reach that public stage, there's value in being $100 million company versus being a $10 million company. Because you can go public and you can get your 20 times price earnings ratio. But underneath, you have to have that governance and full management team in place, kind of like what you were talking about before. But now you're not talking about early stage companies. You're not talking about startups. You've entered a different arena.
Okay, I see. So I'm assuming the approach is assuming the full value of the business in the future, right? What it could eventually become as opposed to what it is?
Yeah.
Okay.
Yeah, what it could become. But then I'm going to discount that back.
Right.
And we're telling entrepreneurs, especially if they're pre-revenue, but even if they're post, if they're early, if you're not offering a 60% internal rate of return, you're not in the investable pool.
Okay, I got a question.
I
I gotta
like
push on that. I gotta
that. Go
push on
ahead,
that.
go ahead.
So how can I get 60% return? Well, offer 60% return if I'm basing it on EBITDA.
I I'm projecting 113% IRR for Nanogas Environmental, and based on 5 times EBITDA.
Mm. You know what?
Or
That's
no,
similar
10,
to
10, 10, 10 times EBITDA.
that's similar to
And the reason, you know, the real answer is, what's your industry? What are the comparables? Who, like you, sells for a multiple of EBITDA? What multiple do they sell for? That's the multiple you use. How much is that worth in your exit year, whatever that is, let's say 5 years or 7 years or whatever, how much is that worth? Let's discount that back and figure out what the internal rate of return is you're offering to the investors.
Okay, I'm seeing. Okay, I'm understanding now the approach you're taking. Um, Usually my approach is
It's
based on
called
what it
the
is now.
it's called the venture capital model.
Right. And
What it is now, these early stage companies are worthless right now.
absolutely.
They have hardly any revenue, hardly any earnings. That's not going to be the value of the company. It's the idea and what they're building that's going to be valuable.
right, I agree.
Yeah, and the only way to look at that is to say, okay, how did you make those projections? Are your assumptions that you use to make those projections reasonable? And then what happens when we discount them back and we have to use a 60% or more internal rate of return? Why? Because when we invest in companies like that, 60, 70, 80% of them are going to fail. And that 60% IRR has to pay for the rest.
Okay, and is that IRR on a yearly basis or the total overall investment horizon?
It's the total investment horizon.
Okay. I was assuming on a yearly basis.
Well, it computes to a yearly annual. IRR is nothing more than what would the average annual interest rate I would need to earn to get the same kind of earnings. It's just if I put it in a passbook and earn this percent,
Mhm.
would I earn this thing that the company is offering? And when I say that's 60% in that passbook, that's what I'm talking about for any early stage company should be thinking about.
Right. What is the highest IRR you've seen on an early stage company on a year-to-year basis?
Before or after they make their
Once they
corrections to
start,
their miscalculations.
yeah, once they start generating those cash flows.
I've seen over 200% internal rate of returns.
Oh,
Is it
wow.
wise to advertise that return though to investors initially? Do you say, "Hey, look, I have a 200% IRR," or do you go a little bit lower than that to be a little bit more realistic with them?
It's wise to build your company, then the numbers and your projections from the bottom up.
Mm-hmm.
We need this number of customers to get to this amount of revenue to get to this amount of earnings.
Okay.
All right. Not as soon as an entrepreneur says, well, we projected that we would take 5% of the market. Like, so you didn't build from the bottom up? That's useless to me.
So you take a bottom-up approach, right?
Yes. Some people call it top down. What I mean is,
Mhm.
so for Nanogas Environmental, I need 338 5,000 barrel per day water treatment locations in order to be generating $200 million a year in revenue.
That makes sense.
Look, it's kind of like my thesis. I think I told you, Len, but we have a bottom-up approach to acquiring for-profit hospitals.
Mhm.
We can't just allocate 3, 5, 600 million for for our hospital acquisition right now. So instead, because we know hospitals rely heavily on third-party services, and there are a few main revenue drivers to the hospitals, we're like, why don't we just acquire those that the hospital depend on first, build an ecosystem to where the hospital depends on us? Obviously, this has to be in a specific geographical location to make sense. In my case, we're looking at Palm Beach County in South Florida, right? So we're like, hey, look, how about we just acquire the landscape that's surrounding the hospital, make them super dependent on us, and then at that time we move in. But this has to be something that is underperforming. We're not looking at something that is super established to put this together. We need something that is underperforming. That way we can build it up. But as we're building that up, we're implementing, or we're kind of like integrating our processes and procedures.
We've talked about to a couple different companies with several with hospital applications. One of them says just with basic bad data in their database, it's costing hospitals as much as 10% or 20% of what they could be doing, down to the bottom line. And they have software that can figure that out. So what if you could acquire a hospital that's, has their data screwed up, and within 2 months you can fix it, right? That might be really interesting.
Absolutely.
We talked to another company that is all about, one of the biggest costs for hospitals is people coming back. The government doesn't pay for that anymore if they got an infection in your hospital, right? How can you reduce those infections? The infections are the people killer. It's not the surgery itself, right? What can you do to reduce those infections? Well, there's a big difference between the hospitals. And it's that same risk management that Silicon Valley Bank didn't have, that the poorly managed hospitals don't have for their infections.
I agree. I mean, even not just the infections, but these poorly managed hospitals, like one of the number one overhead in hospitals is, I believe, wages. I'm sorry, the nurses in the hospitals, right? So, I mean, how many patient per doctor is it, and how does that affect the quality of care?
I hope that hospitals are starting to think about, we've got to staff our nurses better. We've got to pay them better. And if we do that, it's going to end up coming back to the bottom line, because we're going to have happier customers that are willing to pay more. They want to come to our hospital. They want to, and we're going to have fewer incidents, fewer lawsuits for malpractice, and less infections, less poor treatment. There's been studies that have shown that when patients feel listened to, that same thing that might have been a malpractice suit goes away, because the patient knows that feels listened to. They feel like they got good care. If they think they got good care for this, it turns out the same procedures were done, but one customer thinks they got good care and the other one doesn't. The hospital is more likely to get sued by somebody who thinks they didn't get good care.
So an increase in patient care would actually decrease malpractice lawsuits.
Yes.
That's fascinating. What are your thoughts on this, Valentino? Because you and I, we were discussing some of the inefficiencies in the hospital system. What are your thoughts on some of this?
Right. I mean, largely I like to focus on the side of pharmaceuticals. A lot of the hospital visits end up with pharmaceuticals or prescriptions. And sadly, if you don't have insurance, and even those that do have insurance, it's a lot of money, right? There's a lot of middlemen involved in the negotiations of pharmaceuticals. I mean, a lot of them honestly come from China, and they're manufactured for pennies on the dollar. And then you have these individuals that just hike them up. You got medication that really costs $2, and hospitals are selling them for $2,000. So how can we address that issue?
So before I jump in on this, I'll say that there's a lot of failed research. We have to pay for that failed research. And so that, if you're paying $10 for something that costs $1 to make, that $9 is going into all that research that took for the 10 failed drugs that went through research and never got approved because they didn't work, right? So understand that you're thinking about a different kind of market here, and you can't just say, well, it costs $1, why can't they sell it for $1.10? Well, they can, but then we get no research, right? Then we get no new no new inventions. So we have to keep that in mind. On the other hand, um, I'll say that my I'll just give one more story that is like way off base probably from what you're thinking. And that is, I think that we're suffering in the US. We have a declining uh, um, life expectancy. And part of the reason why we have that is big food and part is big pharma. They're helping each other by selling us bad food that's making us sick and then selling us drugs to help solve that sickness. So over the last year, I lost 30 pounds and I started looking at how much sugar was in every piece of food that I bought and I eat. I'm talking added sugar. Fruits and vegetables, great.
Right.
I'm talking about processed foods. And so I think, we need to, maybe all this gets solved with another pharmaceutical because Eli Lilly just announced, these fantastic results on a weight loss drug, which is like the panacea. But maybe we just solve it by stopping eating, processed foods, highly processed foods.
I like what you're talking about. I've seen that in Europe, a lot of products and a lot of ingredients that we do have in products here are banned over there. Right. And yeah, we see weight loss is a big topic, is $1 billion industry. Everybody wants to lose weight, but they don't address the root cause, which is what you ingest, what you eat.
Well,
Like you've stated, there's a lot of sugar. A Starbucks
our
coffee can
food,
have anywhere between
yeah,
50 to 100 grams of sugar.
they just fixed part of our food pyramid, but they didn't fix it enough. And that's because the food pyramid rules are written by the big food companies. And they know that people like to eat. It tastes good if you have sugar in the food. It tastes good if you have a lot of fat in the food. And so people want to eat that. They put it in.
Okay, I got a question. I grew up in Costa Rica, so everything I ate was organic and it was locally grown and sourced. When I came to the United States, which was a few years ago, I noticed that fruits and vegetables are 2 to 3 times the size as over there, largely due to GMO. Is GMO really making us healthier? Is it making these fruits more vitamins and minerals and more flavorful, or is it really a downfall? They're already contaminating natural sources of food.
Um, I think you already know the answer. The one thing I would say is that uh, the amount of nutrients in the food is based on how we do our farming. It doesn't have to be organic. You just have to make sure the right minerals are in the earth that you're growing that food on, right? And farmers these days are addicted to putting, nitrogen, phosphorus as fertilizer without paying attention to all the other micronutrients that make the food nutrient rich. And if you pay attention to all the other pieces, your food grows bigger too.
Right. Ending on that topic, we're gonna circle back to your platform. Ansi mentioned to me it's about 3 people a month that get the chance to go through it. Now, how many people do you see on average applying, and what differentiates those 3 from the other?
Um, we've been lucky enough that the three we have presenting are generally good companies. I would say 50% of them I would classify as investable, meaning I wouldn't feel embarrassed recommending somebody invest in them. But I'd like to get that to 100%, right? But it's not that hard to get in right now. Actually, we would love to have, more deal flow is fine, right? We can take on more companies that are interested. One of the biggest things that kicks them out is, we're working with early stage companies. They have no money and they don't want to they don't want to pay $500. Now, and that's not the pitch. That's to get the presentation coaching that should help them with every investor and every time they go out over and over again.
Mm-hmm.
I'd argue
Right.
that's a solid investment. 500 is a steal.
We think it's really good, and we've had people who, from Groupon that were connected to Lightbank Venture Capital, or that were connected to, or that were, had their own marketing agencies, and they go through our program and they go, these are things that they kind of know how they should work, and yet they're not using them in their own pitch. And so we've had people saying, oh, I paid the $500 even though I'm connected and I know what VCs want. And then they think, well, I paid it. I'm hopeful that we can just learn one new thing.
Right.
And then they get through our pitch and they go, oh my God, this was the most valuable pitch advice I've ever gotten.
Right.
I say we get 90 to 95% of the people thinking, I've never had this kind of good advice on my pitch before.
That's great. Now, as you know, we have a group of individuals. We got innovators. People are looking to acquire businesses. I assume your doors are open and you're always looking for new talent that you could recommend to investors. But what's your criteria? We like to recommend some of our people, but we want to know how do we differentiate from those that are time wasters to those who are potentially the next big thing, right?
My biggest gate when I think about it is, do they have a unique selling proposition that's protectable? Do they have a barrier to entry? Or are they what I call a hot dog stand? You can have an amazing hot dog stand that's worth it for M&A. You might want to buy companies like that. They're killing it from an operational standpoint, and they're beating all their near-term competitors. But everybody could copy them if they just operated as well, right? I think investors that come to our events are looking for things that they have patents, or they have something that really stands out that just is difficult to copy for somebody else to copy.
Right.
And that's what gets, I think, our investors excited.
Mm-hmm.
And so we look for that. And then we look for people that are coachable. We've been in coaching sessions where it became apparent that they weren't coachable. And we just said, I don't think we can help you. And we backed away. And we've been in coaching sessions where the company was coachable, but we came to the realization we were just putting lipstick on a pig. And they weren't going to be, they needed to have something better to set themselves apart. Yeah.
Great. Ansi, any closing remarks? We're about to wrap it up, nearing 2 hours. It's been an honor to have you on the podcast. We thank you very much for your time. I know it's hard to make it, but Ansi, any last remarks?
No. Really appreciate the time, Len. And now, how do you want our guests to reach out to you, or our members to reach out to you? Or do you want us to, like Valentino said, have those that reach out to us and we reach out to you with them? How do you want to handle that?
I think they can go ahead and reach out and, start at our website. If you want to pitch in the monthly event, bnchicago.com. You could go there to sign up for the May 2nd event and see what it's like. We really try to help our entrepreneurs. So you asked if it's like Shark Tank, sort of, but we try to be friendly and helpful. And I think everybody who attends try to be friendly and helpful, even as they ask their questions. If you want to have your company evaluated to pitch at our event, there's information on there about that. But that goes to, you can apply, and that just goes to our, to Lauren Minkus. Send a deck directly to his email address. And then, in addition to signing up for the upcoming event, you can I would recommend that, take a look at all our advice, and because we'll give it away to you for free. And that's by watching one of our seminars on how to create a deck that investors will love.
Could we live stream the event on the May 2nd, with some of our?
Yeah, that would be great.
Mhm.
We're on Zoom, so technically I don't know how you want to hook those up, but
No, we could
absolutely.
handle that. As long as we get in there, we could actually
Yeah.
stream and have our members looking at whatever we want them to see.
Yeah, we'd love that.
Okay, great.
Thank you very much.
Great.
Mhm.
I really appreciate it, Len. You and I, we've talked again offline, and we're going to continue to talk offline. We share a common connection, Scott, right? So we're going to continue the conversation, and we're going to, hopefully I'll meet with you when I get up there to Chicago to meet the rest of everyone else. But it was a pleasure having you. I actually want to have you come back on for another episode in the near future. In fact, because this was really great. We had a lot of great questions from our viewers, which Valentino, he took care of earlier in this episode. So again, really thank you for, giving us 2 hours of your expertise and capital raising background. And we really look forward to having you on a future episode.
Thank you. I enjoyed it. And now, is this recorded so that,
Yes.
so I
Yes.
look forward to getting the recording, and I'll distribute that as well.
Correct.
Absolutely. Where can
Okay.
could these individuals reach out to you, connect with you via LinkedIn or?
Yeah, LinkedIn is great. If be very careful and let me know how you found out about me if your business is lead generation, because I'm just getting so many bogus LinkedIn requests from lead generation people that I just am starting to ignore all of them.
Maybe they
so
could add.
if that's your business, then give me some explanation of how you found out about it and why we should link, besides, oh, you want to generate leads for me, because if that's
Right.
it, I'm not interested in somebody generating leads for me.
Maybe they could add something kind of like, IB acquisitions or something like that.
Yeah.
Right. So that way, they came directly from us. That would be great.
Yeah, happy to do it. We have there's a company page, even though it's not really a company, for Business Network Chicago Venture Forum. There is a company page for my company, Concept Equity Group, and there's a company page for Nanogas Environmental. And any of those, if you want to follow those, that's great.
Great. Again, appreciate the time, Len, and we look forward to having you on another episode. Hey guys, that was tonight's episode. Again, really great. Feel free to reach out to Len via the website link that we shared with you or on LinkedIn. Again, be sure to add IB Acquisitions if you reach out to him on LinkedIn. And lastly, this show was brought to you by IB Acquisitions, as you guys know. So that being said, thanks guys, and we'll catch you next time.
All right, thank
very
you.
much.
Bye.
All right, and we're gonna be doing an after podcast show, myself and Nancy. We got a lot of things to discuss, so make sure to stick around for that. Coming up soon.